If you can copy it using AI in a weekend, we're never going to invest. We look for things that are much harder to do, where the AI that's used helps run the company, do all the things they need to do, marketing, it makes the user interface better, whatever it is. But the underlying technology is actually super hard to do. One of our companies is Hierarch, and they are replacing AutoCAD for building custom homes. It allows you to work on the home design and move a wall, move the garage over, make that ceiling about 6 inches high, or move the island, whatever you want to do. Every single thing you do, it makes all the adjustments that are necessary, that are an effect of the one change you made. It tells you the materials difference, tells you the cost difference, etc. And then the output is actually build-ready blueprints. It saves probably on average of 3 months plus per home when it's being built. The AI on top of that makes it magical to use, and also does a whole bunch of the things that allow it to work much more efficient and helps the company run and everything. But you could not do this without the underlying technology that was built first. There's no way you could actually print blueprints and start doing construction with a quick build like that.
Hey everyone, welcome back to Funded. I am Alex Wittenberg, and today we're diving deep into the investor's mindset with someone who has spent time on both sides of the boardroom table. Jed Katz is a managing partner at Javelin Venture Partners, where he's been investing in early stage startups for the past 15 years. Before becoming a VC, Jed was a serial founder himself. He built 4 companies. So when he says Javelin invests in startups the partners would want to build themselves, he really means it. In this conversation, Jed pulls back the curtain on how Javelin evaluates the 1,000+ companies that they see each year to find the 5 or 6 that they'll actually invest in. We dig into the 2 founder characteristics that Jed says are absolutely critical, scrappiness and intellectual honesty, and why one of those is much easier to spot than the other in investor-founder conversations. We also tackle the elephant in the room that every investor is thinking through right now. With AI making it possible to copy most software in a matter of weeks, how can startups build something that won't get commoditized? Jed shares some interesting examples from their portfolio, including a company that's replacing AutoCAD for home builders, to show exactly the types of moats that they believe still matter in 2025. And if you're a founder prepping to fundraise, you'll definitely want to hear Jed's take on the most common unforced errors he sees in pitch meetings. I really enjoyed this conversation with Jed. I think there are a lot of bits of wisdom in here for startup founders, and I'm really excited for you all to take a listen. So let's get into it. Jed, thank you so much for joining me on this episode of Funded. It's really great to have you, and I'm excited to learn a little bit more about Javelin Venture Partners and how y'all evaluate startups.
Yeah, my pleasure. I look forward to the conversation.
I'd like to start off at a very high level. Could you describe in your own words, maybe the way that you would explain to a founder what Javelin's investment thesis is and how you stand out in the crowded venture capital landscape?
Yeah, sure. So Javelin has been around for about 15 years. This is our 5th fund. We've done about 120 deals, each within the $1 million to $4 million range initially. So it's seed, early Series A, and we tend to invest in things that we would want to do if we weren't doing this. We're all former founders, so it's really, we lead with kind of passion. Do we love the idea? Do we think it's scalable and capital efficient and would be a lot of fun to build? We have a lot of science behind how we make decisions on what we actually select. It has a lot to do with the founders themselves, their ability to be a visionary, but also act tactically, to recruit well, to raise money well. The idea itself, how unique it is, how clever, how protectable, the barriers that can be put up, the pure scalability of it. And lately, especially with all the AI stuff happening, really how hard is it to copy is one of the biggest things. Is it really difficult to do, or is there some advantage they can get that they can hold on to for the long term?
It's a really interesting thesis. And it strikes me that the qualities that you describe could be found in founders across all different types of industries. And looking at your portfolio company page, it seems like you've invested in a pretty wide range of different types of companies over the years.
That's a good observation. We do not start with sector. We have found that some of the best deals we've ever done in 15 years, we would have never found if we started with sector. And so, yes, the criteria we have both for the business, the opportunity, the founders, those can apply to a wide variety of sectors. Now, we tend to have a lot of expertise in SaaS, consumer marketplaces, fintech, prop tech, healthcare, IT. AI applies to all of those. And so we stay away from things that we don't have a lot of expertise in, like life science, bio, expensive hardware, things like that. But yes, we find the other criteria is actually more important in terms of predicting the success.
Yeah, especially at the seed stage, right? You are mainly investing in the founding team at that stage. Obviously, they have the outline of an idea and they have a plan for how they're going to pursue that. But I imagine that a lot of times you invest in a team and they pivot one or more times in that following couple of years to
Right. Well,
ultimately land.
you make two different statements there. So I just want to, the first one, I feel like you kind of described pre-seed, which is a little bit before we invest. We invest
Okay.
when there is, we call it signal before traction. But when
Okay.
some progress has been made, there's product, maybe there's early sales, maybe there's early usage, and you can kind of see how people are talking about it or the virality of it. There's some signals, early recruiting, etc. Stage wise, we call that late seed, early A. When we
Okay.
come in.
So then the pivoting component is not as prevalent.
Yeah. So with the pivoting, it is true that some of our very biggest companies, the thing that actually took off within the company was not what they had when they originally pitched us. The word pivot is thrown around a lot. So I don't know if it was a full company pivot or in some cases, just one of their core products took off much faster than the other things they were doing.
Could you give an example of when that worked particularly well?
Let's say Smart Asset, for example, very successful company, a leader in all type of fintech products that help consumers figure out their most difficult financial decisions in their life with sophisticated calculators and tools and content. However, the part of the product that really took off was helping people find wealth advisors. When somebody first comes into wealth, who should they talk to and why? Who's a good match for them? And it helps them figure that out and set up appointments with the right people and interview each other and then eventually select one. That business became something that is turned into a massive part of the company where they now place somewhere between $2 and $3 billion a month with the wealth advisors.
That's really interesting. So they came to you with more of a concept around the tooling.
It was much broader.
Okay.
They're still great at that, right? They still have the best content out there in terms of your financial decisions. But in terms of the revenue, this one particular product grew far beyond everything else.
Yeah, that's really interesting. And I think it touches on probably one of the biggest success factors for early stage companies, which is that ability to just try a bunch of things, iterate really quickly, and then identify the things that are working and double down on those. At like the early stage, you want to get a lot of shots on goal instead of being pigeonholed into one product idea and being open minded about, like being pulled in whatever direction the market is pulling you.
So I guess I would phrase it as two important things. One is being innovative, right, and constantly inventing and seeing what the market needs and the pain points and inventing that. The second is being very data oriented. So following the data of what works, what can scale, what is going slower, and where you should put your resources. And I think that's a great idea. That's a great example of a company. And Thumbtack is another one we have where they were so data focused, and as they followed the data, they figured out how to build the giant business along the way.
Especially today with the amount of data that companies have access to, being able to steer the ship based on the data that you're bringing in can be a real competitive advantage.
Yeah, and being thorough enough to study the data, really see what it's telling you and adjust.
I like the phrase signal before traction, and your thesis also leans heavily on the founder dimension of the startup that you're evaluating. How would you say that you weigh the different criteria when you are evaluating a late seed, early Series A stage company, maybe divvying it up between the traction, the team, and the market?
There's some things that they have to check the box on, or else we won't get to yes, right? If the market is not in the multiple billions, we're just not going to get there. If we don't think the founder can recruit well or raise money well or execute well, we're not going to get there. Some of the things are just going to be unknown, right? How they're going to innovate after we invest, what some competitors might be doing that we don't have visibility into yet. What products are going to develop along the way and how big those markets are. We kind of figure out what we can figure out. And the bet is, are they going to figure out more along the way and be able to capture a giant part of hopefully a very big market? Some of our bets we're betting to really win, to take over the market. Others are just to grab a ton of market share. It's art and science. You don't have all the answers. This is early stage investing. We always think that later stage investing would be so much easier because you have so much data at that point. This is limited data, and you pattern match. Certainly after 20 years of doing this, you realize how bad you were at it, a long time ago, and how much more pattern matching, how much better pattern matching you can do now at this point in your career.
It's a good observation, and I mean I think that applies to anything. You should always be looking back at your outputs in the past and thinking like, oh, that was actually not that good, because that means that you are getting better at whatever it is that you're doing.
Yeah, especially at evaluating people, the founders. I mean, you really learn who is intellectually honest, who's capable, who's going to bring a lot of drama, and who's just going to get it done and take feedback along the way and bring on other great people. And it's really, you get much better at identifying that the more you do this.
Yeah, that's super interesting. You just hit on a couple of really great founder characteristics there, but just to put a finer point on it, are there one or more characteristics that you are looking for as the most reliable success indicators, specifically within a founder or a founding team when you're having initial conversations for an early stage investment?
I'll give you two. One is scrappiness and one is intellectual honesty.
Mm.
And so scrappiness, like they're going to figure it out. They're going to their asses off to figure out the answers to things and get great people to join them and figure out how to fundraise and get customers early and, fix problems and get referrals. And they're going to do all that stuff. That takes a lot of scrappiness. Intellectual honesty is more about like, are they really being honest with themselves, with us, asking for help when they need it, that type of thing. Both of those things are crucial to us.
Which of those do you feel you have a clearer signal on from the initial conversations based on the decade plus that you've had, getting to invest in folks and then seeing how it actually ended up playing out?
The easier one to figure out is scrappiness. At that point, the entrepreneur should have some history of things they've done in the past or what type of person they are. It's easy to reference check them, not based on who they give us, but all the other people we know that might have come across them in their life. We can also tell just in how they brainstorm with us, how they've gotten their initial customers or initial users or tech built. The scrappiness is usually something you can figure out. Intellectual honesty is harder. We put them through various exercises along the way to try to figure that out. And obviously, we ask people about them. But look, people have been practicing their pitch a million times by the time they come in. It's a great show. It looks really good. Everything looks really good, right? And so the ones that come in and tell us what they don't know or the problems they're having or where they need help or just have a very productive brainstorm back and forth with us and take feedback and give feedback and all that. Those are the ones where it's easier to tell there's real intellectual honesty there.
And that's a really great tip for founders, I think, based on the conversations that I've been having with VCs, is to not try to dance around the risks inherent with your business or the areas that you are still trying to figure out, because the investors, no doubt, have already identified what those risks are for the most part, or they're already thinking about the open questions. And so if you try to sweep those under the rug through your initial conversations, I think that probably is a pretty good signal that they aren't being intellectually honest with you, or at least like
Yeah.
completely candid with the way that they're evaluating the opportunity.
Or if you act like everything's going to be easy, right? And building startups is hard. And if you come in and just say, oh, yeah, this is the easiest thing in the world we're going to build. We'll be at 100 million in revenue in 2 years. It's just not believable. One example, we brought up Thumbtack before. When they originally pitched us, there were questions we asked where they didn't have the answers to. And they said, we don't know that yet. We're going to go back and figure it out. And they came back a few days later, having built a tool to figure out the answers to the questions we asked. That was really impressive.
Yeah, that's both a show of the intellectual honesty and also the speed that they're able to iterate. So I'm sure that was a really strong signal.
And that they were going to be very data focused. They were committed to it.
Let's take a quick step back and talk about your investment process end to end, kind of your investment funnel. Could you start by giving an estimate just so people have a sense of the scale of opportunities that y'all are evaluating on an annual basis? Could you give me an idea of how many startups come across your desk on average in a year, or how many you expect to come through this year, and then how you narrow that down from total pitches to first calls to diligence to ultimately sending the term sheet?
Yeah, I mean, look, in the neighborhood of 1,000 a year that we take a real look at, there's obviously more than that where we get blurbs of, and, it's kind of an easy no for whatever reason it doesn't fit our criteria. We probably discuss about 20 a week, start getting deeper on a few of those. We probably do on average 5 or 6 a year. I think we've made about 120 investments over the years. For the ones we don't waste entrepreneurs' time. So the quicker we can get to know, we help them with some ideas and we point them in the direction of funds that might make more sense for them. For the ones that we're interested in, initially it's one or two of us that meet. Then it's the whole team that'll do one or a few meetings while we're doing diligence in the background. And the whole process from kind of first meeting to term sheet is usually under 30 days. And then, a relatively quick close after that. As soon as we decide we want to do something, the sooner they are back focused on the business, the better.
Yeah, absolutely. I think that's one of the best characteristics of a VC, based on the conversations I've had with founders on the other side of the funded series, is being quick to an answer, whether it's either yes or no.
Right.
No is so much better than a long, drawn out no, because there's such a high opportunity cost to that time when you're going through the fundraise process. You can only engage with so many founders at a given, or at so many investors at a time.
Yeah, look, that's really a bad thing that some VCs do. I mean, they will meet with everybody multiple times just to build market research for their own benefit.
Right.
Well, it's really unfair to the founders who are, desperately trying to get a round raised, very short on time, also trying to build their business. Really, there was no hope of getting to yes with those funds, and they're just wasting their time.
How would you say that you source the majority of your pitches that you end up taking first calls with? Is it inbound? What would be the split between inbound, outbound within your network? And how has that shifted over time as well? I imagine it's probably changed a little bit over the last 15
For
years.
sure. It's a pretty wide distribution now. I mean, we've been around a long time and people know what Javelin does, right? I mean, we really, that late seed, early A, that $1 to $4 million check, it's people are aware of it now. So we get a lot of referrals from other entrepreneurs, from seed funds, from, we're very active in at Berkeley and Stanford and Harvard and other places. We speak on a lot of things. A lot of times the referrals come in from, we might have invested in something in the sector and they get introduced to us from either that founder or other people in the sector. It's all kinds of different ways at this point. I can't say there's one source that's the biggest. It's really all that stuff together, and you never know where you're going to find that next one that just like blows your mind. But almost always it's a referral from somebody in our wide network that realizes that this matches our criteria. There's a personality match here. We'd be a great partner. They'd be a great partner for us, and they connect us. Those are the ones that get done the quickest, I'd say.
Yeah, that makes sense. A little built-in social proof there. If you're taking a look at 1,000 companies a year, that's a lot of data to ingest for a small team. What does that initial evaluation process look like? Is there any sort of framework that you sort of view companies through, or any sort of tooling that you use to really quickly get up to speed on an opportunity to decide whether it's worth meeting with an investor or with a founder for that first call?
We have our core criteria in that first meeting. It's really that simple. If they don't hit all of the core criteria, it's going, it's going to be a quick no. So if the market is too small, or we didn't like the founder for some reason, or it's easy to copy, whatever it is, if those things are not checked, it's a quick no. Right. The
Mhm.
the bigger question is when it gets to all of us. and we're taking it real seriously. We're marching forward to kind of divide and conquer the diligence and try to figure out reasons why we shouldn't do it. Because at
Mhm.
some point, kind of our passion to want to do it takes over. And we're founders at heart. So if it's something we'd want to be joining, and if we weren't VCs, we're going to be biased toward yes. So we try to convince ourselves why we're wrong, and if we're still pounding our fist on the table and want to do it, we get it done.
Could you give a little bit more detail, a little peek behind the curtain into what that little sparring process looks like internally? How do you bring these opportunities to the rest of your group, and what does the conversation look like after you make that initial pitch based on your first meeting?
It's interesting. We, somebody, one of us will bring it up, and we'll start going through the business idea and the criteria and why we like it, why we think it fits, and then starts the process of being completely beat up. And you're against it, and you're kind of fighting all the reasons people are throwing at you at why this might not work or might not be a good fit for Javelin.
Is that the exercise? Does everyone else at the table, do they have to put on their devil's advocate
No,
hat and
no,
and
no. Sometimes every now and then it's like, oh my God, everybody loves it. March forward as quickly as possible. That does happen, but it's rare. It's very rare. Usually there's at least one, if not a couple people in the room that are fighting back right from the start. And either you kind of succeed in that exercise and then take the next step in the process with the company. Or sometimes, if one of us is banging our fist really hard on the table saying, look, I have to do this deal. This is like, I'm in love with this company and this founder. I need to do this. Then we'll likely do it. The opposite happens too. If someone's banging their fist on the table saying, I don't trust this person, or for whatever reason, like this is, I know 5 companies just like this and it's going to be commoditized so quickly, then we're not likely to do it. So yeah, if they can survive kind of that first introductory debate, then it's team meeting and further diligence and all that. And then we're all trying to figure it out together. You're walking into it every Monday morning. And if you're going to make a case for something, you need to be prepared to do that. And you have to figure out ahead of time, is this a deal you're going to be banging your fist on the table for? Because you can't do that every week or else it doesn't mean anything anymore. Right? You got to do that only a couple times a year. That's kind of the internal process to figure out prior to having that partner meeting.
I mean, that sounds like a really great filter to put companies through. A way to stress test your conviction is whether or not you're willing to kind of go to battle for them and pound your fists on the table, especially based on initial
Yep.
impression that the founder gives you or your initial vision of what the market opportunity could be. So, um, yeah, that makes a lot of sense.
And look, if you're pushing on a string, if your partners are never going to get to yes for whatever reason, then move on. The goal is to get that whole partner meeting with the company that you're very interested in. But you should only do it if it makes sense. If like it's a real opportunity, everyone's being active is actively considering. Right. If for some reason you think it's going to be too hard, then move on.
So if company makes it through the Monday morning partner meeting gauntlet where you are making that initial case and you decide to move into the diligence process, what does that look like for a founder who is considering collaborating with Javelin?
I mean, the good ones are pretty organized ahead of time. So they have a data room set up. They have all the market information, the competitive landscape, that, any legal issues that have come up, all the diligence we would ask for. Then we start doing the background checks on our own and try to learn as much as we can about everybody on the team. We also do a competitive analysis on our own to really figure out who's out there, what are the long-term advantages. We kind of game theory it out. We have more meetings with them and just kind of do a lot of brainstorming with them and try to figure out what it would be like to be their board member. And these partnerships can last 10 years. So is this somebody you'd want to be in the foxhole with for 10 years? That's pretty much it, to be honest. I mean, once we're through with that, we can get a term sheet signed and a deal closed in a matter of a few weeks. So that part's easy. The negotiating is incredibly easy. Like that takes 5 minutes. It's really just the getting to yes, getting to that final yes. That's the hard part.
Yeah, I mean, it strikes me that there's all of the diligence, all of the deep thought that you expect a founder to have already kind of done at the point at which you're ready to go into due diligence. And I assume it's not a check the box exercise, but it's like if they haven't done it, then it's going to be a no go. But it sounds like you spend a lot more of your time evaluating the person and the personality match and the thinking about what that collaboration would look like, as opposed to drilling really deeply into the diligence documents. Maybe I'm off base there, but I don't know. That's just what I hear come.
Both are important.
Yeah.
You're placing a bet that this one investment can pay back the whole fund. Right. So you really need to know that it's a big enough opportunity and that they can grab a huge part of that market or create the market.
Mhm.
And so you do have to have those questions answered. And I think more often than not, the thing that convinces us not to do a deal is we just can't get to the right market size analysis, or we think that the odds of this commoditizing are just too high. And so it's about how special, how unique this is. We know how clever is their approach, how hard is it to copy. And a lot of that comes out in the brainstorming.
What would you say is the most common unforced error that you see founders make within the fundraise process? A situation where you may have been able to get there on pulling the trigger with an investment, but the founder did something or something turned up in their data room that just really kind of turned your partnership off on the investment opportunity.
There's a bunch. I think any type of big surprise that they didn't tell us that comes up. Any reason we question their intellectual honesty. Just not being likable happens. I mean, look, and obviously that's a two-way street. But the if you're going to be a partner of theirs for potentially a decade, you got to really like each other. Sometimes people come in, their whole presentation is kind of boring, and we worry about their ability to fundraise later or their ability to recruit great people. Sometimes they really don't know how much capital they need and like what the uses of capital are and at what point they'll be able to have hit enough milestones with capital left in the bank where they can raise that next round. And generally what that's going to look like, if they're not sophisticated enough in that realm, and I don't care if they're, 20 years old or 50 years old, if they don't have that level of sophistication, they're probably going to run into trouble.
Yeah, I mean, you're evaluating companies at the early stages, but if everything goes the way that you hope it will, then this person sitting in front of you will be leading a several hundred person company in a
Yeah.
couple of years, and they need to have those skills, or at least you have to see that they have the ability to pick up new skills along the way and grow into that role.
Take feedback. We've had two founders come in and bicker with each other, and like that's just not going to work.
You've mentioned the word commoditization quite a few times in this conversation, and it seems like that is probably a pretty common evaluation criteria when you're in these Monday morning meetings. And I assume it's becoming more and more prevalent with the advent of AI. How do you think about that question of companies' moat and their ability to stave off the commoditization with all of the AI technology and all of the technological shifts that we're seeing happening today?
Yeah, it's a great question. It's probably the number one thing we talk about when we're evaluating these opportunities right now. If you can copy it using AI in a weekend, we're never going to invest. The fear is that eventually there's 10 of these companies and that the ultimate multiple that they would get if they ever get acquired or go public is going to be small because they're one of 10 and there's not a clear enough difference between everybody. There's also a fear of just noise where people sound similar to whoever they're selling to. We look for things that are much harder to do where the AI that's used helps run the company, do, all the things they need to do, marketing, it makes the user interface better, whatever it is. But the underlying technology is actually super hard to do. Or there's some other advantage, whether it's a marketplace dynamic or it's a unique content they have or something. I'll give you a few examples. One of our companies is Hierarch, and they are replacing AutoCAD for building custom homes. And they work with developers who are building thousands of homes. It allows you to, work on the home design and make movement changes to it. And millions of changes. Move a wall, move the garage over, make that ceiling of 6 inches high, or move the island, whatever you want to do. Every single thing you do, it makes all the adjustments that are necessary, that are, an effect of the one change you made. Tells you the materials difference, tells you the cost difference. etc. And then the output is actually build ready blueprints. It saves probably an average of 3 months plus per home when it's being built. The AI on top of that makes it, magical to use, and also does a whole bunch of the things that allow it to work much more efficient and helps the company run and everything. But you could not do this without the underlying technology that was built first.
Mhm.
So it's not even close to something somebody could just copy by trying to place AI and start doing home designs. It would be a mess, right? There's no way you could actually print blueprints and start doing construction with a quick build like that. Another example that's completely different is Masterclass. That thesis was, okay, if they can get the A+ people, normally celebrities, but not always, that are the best and the best, best of the best in the world at whatever topic they're good at, teaching it through this Hollywood level media production. Uh, Ultimately, they're all going to want to do it. Ultimately, like, this is the club they're going to want to be a part of, for brand, for legacy, for quality, all that stuff. And once you get all of them, then the things we can do with AI are amazing, because we are the trusted brand that helps them teach their expertise through their many years of building it up through a bunch of different mechanisms. Again, very, very hard to copy once they succeed. And then we talked about thumbtack. Again, that's like a million mini marketplaces where you have to have the supply and the demand and the mechanism to connect the two working perfectly. And building that up is just not something that can be done overnight with AI, not even close. It takes many, many years to get to where they've gotten.
Yeah, those are very different examples of companies that are going to be like kind of resistant to disruption from AI. But I think that gives a pretty good overview of like the types of businesses that will succeed. Either it's deep knowledge of a specific vertical, like with Hierarch, or it's network effects with Masterclass, or it's, well, I guess, platform marketplace sort of dynamic within Thumbtack is a bit similar, but two-sided marketplace.
And don't get me wrong, there's a huge AI component to all of those companies.
Right. In those cases, though, it's more of like a sustaining innovation as opposed to a disruptive innovation.
And it's not something two people in a garage can hack together in a short amount of time just using AI.
Would you say that in your firm's eyes, much of the B2B SaaS space has become a much riskier investment based on the fact that a lot of the software in that space can be replicated in maybe a couple of weeks with a couple of engineers with Claude Code?
It's certainly a sector that's being disrupted the most. That's for sure. It does make the bets riskier. There's great innovation happening still. But no doubt things that were funded, 3, 4, 5 years ago, where they thought they could do no wrong, could see their entire business models evaporate. That's happening. So yes, with SaaS, we're being very careful. Now, with that said, we still do a lot of SaaS. So there's still some really cool things happening that are hard to copy. We'll see what happens here. Sometimes the people that are applying AI to a given problem, there's a lot more elements, a lot more layers to their business than just a quick build of the tech on why they would succeed. How they're able to get customers, what their secret sauce is, that is actually the harder part to copy than just building some of the tech.
So you've seen many market cycles since you started Javelin and before that as an entrepreneur yourself. I'm curious if you and your partners view what's happening in AI now as the start of a sea change in the way venture investing will happen in the future, or if this is just kind of like the latest flavor of a boom and bust cycle, and that it will eventually kind of like return to the mean when it comes to venture investing.
It's kind of like all the things I've seen in the last 20 years are all happening at the same time right now. So it's a level of everything, right? Yeah, there's massive innovation. There's going to be massive disruption. Valuations are getting out of hand again. Some of that's going to just fail because they won't be able to raise their next round. They wouldn't have made enough progress for that to make sense. Or they'll spend too much money and get into this habit of just having too much cash in the bank and spending too much. There's going to be companies with very small number of people and a small amount of capital that can just change everything. Those are going to be fun. we're really looking for those. There's going to be companies you thought would never be disrupted, be completely disrupted right now. And so that's scary, but super interesting. There's a lot of opportunity there. There's going to be some bad things, right? There's, AI is developing so quickly, and there's a lot of bad players out there too. It's going to be interesting to see the kind of some of the horrible things that happen and how companies are created to help protect from those horrible things. I mean, it's a great time to be an investor. I do think the first part of your question, the industry is going to change. We're actually an investor in VC Lab, which helps pre-seed and seed funds around the world get started with back office and network and all the tools they need to use at a fraction of the cost of if they, try to do everything themselves. And it's producing hundreds of great funds around the world. These are funds that invest at stage before us, and it's interesting to see how those guys are using AI to just be very efficient and figure out the types of things they want to invest in. All the cycles are happening at once. There's going to be a lot of wealth creation that happens in the next 10 years. That's for sure. Or there's going to be some people that just create these amazing companies, some of which, they're going to raise just a ton of money along the way and just kind of, force it. The others will be able to do it in a massively efficient way.
You brought up that point just a minute ago that I'd love to hit on a little bit, which is this dichotomy between these mega rounds being raised by, I guess, mostly these are companies that are super capital intensive and require the heavy upfront investment. But then you also have this new cohort of startups being like getting off the ground with teams 1/10 the size of what would have been required like 5 years ago because these new teams are AI powered.
Yeah, it's pretty wild. I mean, they come in and it'll be a few people, but the progress they've made in the first even 6 months of their life, it just blows your mind.
Yeah, I guess I'm curious to hear what you think that AI powered startup of the future will look like from like a team composition standpoint and how some of the companies you're evaluating are leveraging AI to give themselves 10x leverage over a traditional startup.
Yeah. Let me kind of phrase it differently. Anyone who isn't doing that is unlikely to get funded. Okay. So anyone who isn't leveraging AI to do things much more efficiently, and that's from code development to, marketing and content creation and sales, recruiting and execution, everything you can imagine. If they're not using AI to be very efficient, our first question is going to be why. And, if they don't have a good answer there, it's a quick no. So I think you're going to have to be competitive going forward, both in terms of speed and efficiency.
Does that move the goalposts for you a little bit in terms of the progress that you expect an early stage team to be able to make with small headcount? Do you expect company to be further along than they would have been 5 years ago coming to you for a seed stage investment?
I'm going to say it a little differently. So the quick answer is companies are going to progress faster. So if we would have invested at the exact same phase as before, they would have been further along. But it's going to cause us to move a little earlier, get in, and the signal is going to present itself faster. So we're going to come in earlier, look at the signal and make a bet on if they can continue at this pace and innovate and create a big company. I think what's going to happen is because the signal develops quicker, it's going to become traction quicker. And the funds that come in at these super high valuations with big checks, it's going to happen quicker. So everything's going to kind of shift to the left a little bit. And we're prepared for that, both in terms of the earliest things we do, but also writing slightly bigger checks to things that are a little bit later and have proven more.
How do you approach those situations with founders where you invest in them early and then 12 months down the line, a mega fund comes in and wants to throw 50, $100 million at them? How would you advise a founder to assess? Obviously, it's not always going to be this is a bad thing or this is a good thing, but how would you think through that with a founder to decide whether that's something that they should entertain?
Yes, great question. Obviously dependent on the business and how fast they can scale after that. And do they have the uses of capital for that much money? But the first thing we would do is tell them the horror stories of the last 20 years of companies that we've invested in that have done that and brought in way too much money, got into this huge expense structure, and for whatever reason didn't hit the milestones fast enough to make that all work, either to raise the next round or just to survive. If they take that kind of money early on, they have to be very eyes open in terms of the risks, what they're going to spend it on, how much they're not going to spend, and act like they don't even have, and just can they get to a place where they control their own destiny? Also, just a ultimate exit value, right? I mean, some of these rounds are done at such high valuations. You just have to have a lot of faith that you can build something much bigger than that.
Taking those massive funding rounds is signing up to return capital in excess of that to the investors who go in at that valuation. So, yeah,
Yeah,
you really are putting a lot of strain on the team. I mean, it's a big swing, which is we're in venture four in a lot of situations, but at the same time, it's kind of just the nature of the venture capital cycles, right?
I'll tell you though, the opposite happens too. Where I mean, we have some great companies where we led the A, and the company just gelled super quickly and became profitable, and was able to keep doubling profitably, where they actually didn't need more capital. AI helps a lot with that, but if you find those types of companies, oh, those are just fun. Those are fantastic. Then they have massive optionality from that point forward. They control their own destiny. It's going to be a huge return. It's really just a question of how big do you want to make it at that point.
right. And less dilution for the initial investors as well. What's a belief that you have been kicking around internally at Javelin that might cut counter to what's seen as conventional wisdom in the startup space today? Like, what's something that you believe about how all of this is going to play out that might be a little bit contrarian?
I'm not sure we totally think that way. I mean, we definitely can be contrarian on specific companies. I'm not sure we're the ones to be arrogant enough to look at the whole tech world here and go, oh, everybody's wrong about this one thing, and we know the answer.
Said another way, is there like a specific area, segment, technology that you think people are overlooking right now?
There's a bias toward anything that is very AI specific. And so there's a lot of great companies being created that aren't necessarily like, the core of the company is not AI, that are just being missed, right? Because that's not the hot thing. But these are companies that can become multi-billion dollar companies still. And so we are going to keep evaluating those for sure. AI might make the company run better, but maybe the core product has nothing to do with AI. I think there's a bias to make sure everything you do is AI right now. We'll certainly do a ton of it, but not everything.
That's a really interesting point because you could also kind of reframe that as on what time frame is AI going to be able to be integrated into a company? Like maybe there's a company today that doesn't have AI at its core, but a year from now, AI could become kind of like a sustaining technology for them if they've done the hard work up front, like you were talking about, to like build that strong foundation of a business.
Yeah, I mean, AI is going to impact everything. It's going to impact the way people run their companies, and how their products are used and everything. But some companies are more AI centric than others, I guess is my point.
Right. Yeah, for sure. I'd love to. We covered a lot today. I'd love to hear if you have any advice that you would like to, put on a billboard on the freeway on your way into San Francisco for founders who are raising capital that will increase their chances of success and lead to more productive conversations between founders and venture capitalists.
Get great mentorship, do a ton of early meetings to get the back and forth, and get feedback, get tons of feedback on what's working in the presentation, what isn't. Is the amount of money being raised the right amount? Are you matching well with the funds you're going to be talking to? Did you find the right champion in each fund to have that first meeting with, and hopefully be the one banging their fist on the table? Are you being honest with yourself on the idea, the competitive nature of the space, your ability to scale it up? Is it big enough? Act like you're a VC. Would you invest in this?
That's really great feedback. I think um, the iteration piece and being willing to cycle many, many times, even like before you're necessarily truly ready to take a check, like getting those early signals, iterating along the way, also establishing a track record for yourself, telling investors what you're going to do, and then following through and actually doing those things. I think those are like really great ways that you can set yourself up for success when it's actually time to start bringing in term sheets.
Yeah, the other thing is, talk to other founders who have raised early rounds. who have raised seed and Series A's, and learn from them. Have them grill you and point out all the things you need to get better at.
Yeah, that's part of why we started the funded series, especially on the founder side, is to really give a raw look at what it takes to raise a seed Series A round of funding so that founders understand what they're signing up for when they kick off a fundraise process. And then these conversations with VCs like yourself are also super helpful just to get them more acclimated with the things that investors are going to be looking for and what they need to come prepared with and how they can best have those conversations that build trust throughout the process. So yeah, I think that's great advice.
No, I think it's great that you're doing this, and hopefully, people watch these before they go out and fundraise.
Absolutely. We hope so too. Well, I think that's a great place to wrap. Is there anything else that we didn't cover today that you wanted to make sure that we get out there?
No, look, I think you covered it all. I mean, from Javelin's perspective, we're actively investing. If people feel they fit all this criteria, we'd love to talk to them.
Sounds great. We will be sure to pass those great founders along, the founders that you would want to build companies alongside. So, Jed, thank you again so much for taking the time today. Really enjoyed the conversation. I'm excited to get this out into the startup community.
Awesome. My pleasure. Great conversation. Thanks.